So recently, I've been stuck between a rock and a hard place. I've been trying to figure out when exactly is the best time to buy a stock. I've been trying to decipher this thing in my head, trying to think about it. I've been asking people questions. I've been asking so many things, trying to figure out, do I wait to buy a stock, or do I just buy into the stock and ride it out with the company? Or what exactly do I do? What is the best method to buy a stock? And then I went on a trip. No, it wasn't one of those trips where you go find your mind and you get all this epiphany. No. I went to visit my sister, and while I was visiting my sister, I took this book with me. It's called Common Stocks and Uncommon Profits by Philip A. Fisher. The thing about this book, of why I even wanted to read it, was there's a little thing on the front of the book. There's a little quote from Warren Buffett who says, "I am an eager reader of whatever Phil has to say, and I recommend him to you." So, I mean, if Warren Buffett has recommended me to go read from anybody, you know I gotta check it out. So I decided to take this book with me on the flight, and I read this book on the flight there and back. If you've read a lot of other books, if you read The Intelligent Investor and a bunch of Peter Lynch's books, this book is basically kind of in line with it. So there was a lot of stuff where I was just kind of glossing over, but then we got to a section in the book that kind of helped me understand when to buy a stock. So I'm going to pull up the page and I'm just going to read an excerpt of the book because I think it's best put in its words, and then we'll talk about it a little bit more. So he says, "The solution to this problem is not especially difficult, as in so many other things connected with the stock market. It just requires an extra bit of patience. I believe investors in this group should start buying the appropriate type of common stocks just as soon as they feel sure they have located one or more of them. However, having made a start in this type of purchasing, they should stagger the time of further buying. They should plan to allow several years before the final part of their available funds will have become invested. By so doing, if the market has a severe decline somewhere in this period, they still have purchasing power available to take advantage of such a decline. If no decline occurs and they have properly selected their earlier purchases, they should at least a few substantial gains on such holdings. This would provide a cushion so that if a severe decline happened to occur at the worst possible time for them, which would be just after the final part of their funds have been fully invested, the gains on the earlier purchases should largely, if not entirely, offset the declines on the more recent one. No severe losses or original capital would therefore be involved." And so when I read that, a light bulb went off in my head and I was like, why am I making this thing so complicated? Why am I making this thing so hard? Basically, what that book and what that snippet is saying is dollar cost average. The same thing that I preach for doing with ETFs and doing with index funds is what he's preaching to do with stocks as well. Basically, what he's saying is, if you have found, by the way, before he got to that section, he broke down all the characteristics. It has about 15 characteristics, which, by the way, if you want to check out the book, there's going to be a link down in the description. And I might break down the characteristics of everything that he talks about for buying a good stock. But he says that if you find a company that fits all the characteristics of a good company, which remember, whenever you're buying a stock, you're buying a business, you're buying ownership into a business. If you find a stock that fits all those characteristics, then you should just start buying. You should start buying and dollar cost averaging, especially for those of us who don't have like $10,000 or $2,000 or $6,000 or $8,000 or all this exuberant amount of money that we see people on YouTube talking about. Oh, I just bought $50,000 worth of this share. We don't have that amount of money. We don't have that. Like I say all the time, I invest $50 every week. $50 doesn't make a whole lot of difference in the grand scheme of things in the ways that when you're investing it, it's not world changing, but doing it consistently is much more important, because the thing is, if you can ride that upward momentum, if you can ride the upward momentum of the stock, you're consistently buying into that company. You're consistently buying into that company because you believe in that company, because you've done your research, which is the key thing of this entire thing. It's not about buying at a price point, but buying a good business is much more important than buying at an appropriate price point, is what the point he was trying to make. Is one of the things he said in the book is a lot of us get stuck and we end up never investing in great businesses because we get stuck on the idea of, oh my God, the price is not where I want it to be. Oh my God, I'm so and we get stuck because it's not at the appropriate price. However, the other part of this is you can't just buy every single thing with every single dollar that you have in your pocket. You have to stagger your purchasing. In other words, maybe you have $100 in your pocket, or you have $100 that you can invest every week. Maybe invest $50 of that and keep $50 on the sidelines. Maybe you invest $75 of that and keep $25 on the sideline. You determine what percentage works best for you. But basically, don't use all your firepower. Keep some on the sideline so that if things fall, you can buy more of it. But the idea is just dollar cost average your way into the stocks. Dollar cost average your way into good companies. When I say this, I'm not talking about companies that are very speculative and very questionable, that will have 50% drawdowns and 80% upgoings and all this other stuff. No. We're talking about good businesses that you know are going to be around for the long term, businesses that have a moat, businesses that have a defensible position, businesses that are profitable. These are businesses that you want to dollar cost average into. And so with that being said, we're going to take a look at my portfolio real quick, and just to talk about the fact that this is what I'm going to be doing now. It's what I did when I invested in both Microsoft and Apple. I literally bought every 2 weeks. I was buying $50 into Microsoft, $50 into Apple. At one point, I upped it up to $100 where I was buying into both of them. I didn't focus on anything else. I said I wanted to have at least $1,000 invested in these two companies. And I did that. I just continuously put money in. Now, of course, Apple is not at $1,000, but combining what I have in my Robinhood and what I have in M1 Finance, I have $1,000 in Microsoft. And that's all I'm going to do from here on out. I'm not going to freak out and try to find like the perfect, like, yes, it's still important for me to do that. I'm still going to do all my discounted cash flow calculations and all that stuff. But more important than any of that is figuring out, is this a good company? Is this a company that's going to be around for the long term? And so a few companies that I'm going to be targeting from this point out. One, Disney. I believe Disney is going to be around for the long term. As you guys know, I regret so much not buying more into Disney when Disney was super low in the past. However, I will be buying more of Disney as time goes on. I will be putting more money into Disney because it's one of the companies that I believe is going to be around in the future. And once things start to open back up, I mean, Disney parks are already sold out. They're already sold out, and the pandemic is just barely starting to lift its fingers off of us. So Disney, definitely going to be investing a lot more money into Disney. And also, if we look at my big bets portfolio, which I need to do a portfolio update of this one, I'm going to be buying a lot more into Shopify because I believe Shopify is going to be here for the long term. One thing that I just figured out recently is online commerce, e-commerce is only 14% of the total trade. 14% of all the shopping that is done online, which means there's a lot of room for growth. The other company that I'm going to be focusing on is Airbnb and also CrowdStrike, because I believe both of these companies are going to be massive moving into the future. And also Lemonade, of course. I can't leave out Lemonade. That's my biggest bet of them all. I've lost a lot of money. I'm losing money in Lemonade, but I don't really care because Lemonade play for me is long-term. Like I said, all these companies are long-term holdings. As you can see, I've lost a lot of money, but that's okay. I'm okay with the amount of money that I've lost in those companies right now. At the end of the day, I've not really lost it because it's paper money and it's not real money or real losses just yet. I haven't sold out of it. So that's what I'm going to be doing. I'm going to be buying more Airbnb. I'm going to be buying more CrowdStrike. I'm going to be buying more Lemonade, and I'm just going to dollar cost average into it. I'm going to first focus on buying into Disney. First of all, Disney is going to be my main target. I know it's at its all-time highs, but my main thing is I'm just going to $50. It's not going to be anything epic, and I'm going to reach up. I want to get this to up to $500. And when I hit 500, we go to the next company. And if the next company is at a major drawdown, then instead of buying into Disney, I'll buy into that company. But that's the plan from here on out. There's always going to be money in my M1 spend account to ensure that I can buy whenever anything happens. But anyway, that's all I got for y'all. I hope y'all learned one, maybe two things out of this entire thing. And I hope that this helps anybody that's just getting started investing and you're trying to do it the right way, but you're not able to figure out like, oh, should I just keep waiting and leaving my cash on the sideline? I figured out that I'm somebody who prefers to be 100% invested rather than any other way of investing. But that's just me personally. But anyway, I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all. And I'm out. Peace. Whoosh.